if you have always been really good at figuring out where the market's going to go next week, next month, next year, you don't need any advice from me at all. But most people aren't. And in reality, for most people, unless you're that really, really, really good market timer, of which there's pretty much almost none in history, and none that actually did that steadily on a long-term basis for years and years and years and years, that we can find, then actually time in the market is more important than timing the market. And I've said this for a long time, that for most investors, time in the market is more important than timing the market, because the reality is that the very long history of the market generating very good returns, long-term averages fluctuating around 10%, capturing a lot of the upside of inflation, capturing the upside of corporate business growth. That long-term return includes every bear market ever, every correction ever. And to get that high return relative to alternatives that are liquid, all that matters is staying in. It doesn't require being a genius. It doesn't require buying the best stocks. It doesn't require anything other than stick-to-itiveness. And that stick-to-itiveness is something that in scary times people often get blanched out of. But I encourage you to think through the fact that through things much worse than anything we face now, were wars, the great influenza, much worse than COVID was, socio-political upheaval in America and around the world, the Cold War, and so many other things, including the 1960s, 70s, 80s stair-step inflation spiral, which was huge compared to anything that's happened recently, where people are so afraid of inflation. That through all that period, this process of capitalism enduring and stocks ultimately reflecting that and benefiting those who stayed in and got the benefit of time in the market instead of timing the market, that's been rewarding for those as measured by history, and almost certainly the same processes prevail when we look out at the next 5, 10, 15, 20, 30 years, such that if you have an intermediate to longer term need for equity returns, that level of returns, you really can't find them anywhere else in something that's liquid. And I encourage you to note the benefits of time in the market versus timing the market, and not let this kind of a short-term, scary period scare you out of what's in your best interests. Thank you very much.
Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.